loanable funds is an essential part of it, which is why I got his bloody Nobel Prize. Now, I thought that in 2014, the worries of sensible people like us about this stuff were over, because the Bank of England came out and said what we've been saying for more than half a century, that banks are not intermediaries. Banks originate money and debt. And my preferred acronym these days is not endogenous money, which I think only makes sense to people inside the literature. I talk about bank originated money and debt. Got a great acronym, BOMD, and that's the real world. And this is what the Bank of England said in 2014. Bank lending creates deposits. They don't lend out deposits, they create them. And the Bundesbank said the same thing in slightly more complicated language, but very accurate. A bank growth loans without any prior inflow of customer deposits, and book money is created as a result of an accounting entity. It grants a loan, it puts the credit inside the customer's bank as a sight deposit, and this refutes a popular misconception that bank acts as simply as intermediaries. That didn't stop the neoclassicals awarding the Nobel Prize to Bernanke for that popular misconception. So they just ignore any contradictory evidence, which is, I've just found typical of these twits, that they just, anything that's critical just goes over their head and they stick with their belief system. Now, I want to show that the reason endogenous money matters is that when you have banks creating money, credit, which is the annual change in debt, is part of aggregate demand and aggregate income. And I do this starting from the identity of income is identical to expenditure. And this is the fundamental proposition that even neoclassical accept in macroeconomics. Your expenditure is somebody else's income. What you spend is income for the person who receives your spending. So what I was challenged on this is critiquing my arguments when in the post-Keynesian literature by Brett Feiberger. He said, unless King can show that this is false, then he has to give up his argument that credit is part of aggregate demand. I thought, well, I know it's true. I'm sure I'm right. Michael Hudson and I were on the same page on this. So I should be able to prove it using expenditure as identical to income. So I invented the idea of a Moore table named after Basil Moore. And that shows expenditure on the horizontal of a table and net income on the vertical. And it's showing flows in dollars per year. And the idea here is that your expenditure is on the diagonal, the income is on the off diagonal, and the two are necessarily equal. And the aggregate, the negative of the sum of the diagonal is aggregate expenditure. The sum of all the off diagonal is aggregate income. They are necessarily the same. So let's just illustrate it. I'll start with a simple case where there's no lending or banking. And you have three sectors: household, services, and manufacturing. And households are spending A dollars per year on services and B dollars per year on manufacturing. When you sum the row, you get zero. Services, C dollars per year on housing, D on manufacturing, sum the zero, etc., etc. And then the vertical sums can be different to zero, but the aggregate of those is also zero, which is one reason we work with gross rather than net in macroeconomics. So aggregate expenditure is the negative of the sum of the diagonal, and that gives you minus A to minus F. Aggregate income is A to F. They're necessarily equal. Now let's bring in loanable funds, and this is why loanable funds are such an essential part of the mythology of neoclassical economics. What you have is one non-bank lending credit dollars per year to another non-bank. To illustrate this, I've got the services sector lending to the household sector. So that is not, lending is not a purchase, so it doesn't show off the diagonal, it's a transfer along the diagonal. So the services sector is lending credit dollars per year to the household sector, and then it's spending C dollars per year on households and D minus credit dollars per year on manufacturing. And the A's and F's don't have to be the same as the previous table. It's just showing these are the different flows that are involved. So it's still sending C dollars per year on services, D minus credit dollars per year across there. Now, when you do your sums, credit cancels out, okay? Credit is not part of aggregate demand and income in loanable funds. The interest payments are, because that's actually a transfer. Interest is transferred from households to services, but credit cancels out. There's no role for credit in aggregate demand or income in the myth of loanable funds. So if loanable funds actually describe the real world, then Bernanke would have been right to ignore Fisher, but it doesn't describe the real world. What it does is bank originated money and debt. So what I've got to show now is bank lending, and I've now got to bring in the banking sector, which gives me a fourth sector. And I've also got to look at the assets of the banking sector as well as the liabilities, because money in the real world is fundamentally the liability to the banking sector. And therefore we have household spending borrowing credit dollars per year from the banking sector and then spending credit dollars per year on manufacturing. So the same basic story as the previous thing, only the money they're using is being created by bank lending. So this is now the full table, and all the action is on the diagonal of the liabilities and equity. And you can see I've got household spending A dollars per year on services, B plus credit P dollars per year on manufacturing, and paying interest dollars per year to the banks. And the money they're getting is created by bank originated money and debt. So the debt's gone up, which is the assets, the liabilities have gone up, the deposits, and what you get when you do your sums is credit does not cancel. Okay? Credit is part of aggregate demand and aggregate income. And that's the essential important element of talking about endogenous money, which has been something post-Keynesians and have been arguing about for 50 years. So credit does not cancel out. And because it's such a volatile part of aggregate demand and aggregate income, and it can go negative with no other component can go negative, except the deficit can, but that's never quite the same scale. Credit can go strongly positive and strongly negative, and that makes it much, much more important. So when you look at the data, and the funny thing is, when Bernanke made this claim, he didn't even look at the data, and the data existed. This is a census publication on the Colonial Times in 1970, published in 1975, showing debt by different financial sectors. And the BIS does a similar thing, Dave, with an excellent database that I use extensively in my own research. And this is an extension of my Minsky software I'm showing you called Ravel, by the way, which is designed for data analysis. So this is data from the Bureau of the Census plus the Bank of International Settlements going right back to 1790 for government debt, and from, I think, 1830 for private debt. And when you take a look at it, credit was negative in the 1930s. And this is what caused the crisis. That's why it lasted so long. And that's something which is ruled out a priori by Bernanke's illogical system. This is actually it was Keynes's marvelous statement about Hayek, that he was an excellent example of how a logician working from false premises can end up in bedlam. Well, this is the bedlam of the neoclassical economists. They rule out what matters most and then can't explain the phenomena. So here we have negative credit during the 1930s, and the same thing applied when Bernanke was in the hotspot on the Federal Reserve, negative credit in 2008. And you look at the bottom chart, which are two charts which show the aggregate debt level and then change in debt as a percentage of GDP. You can see that the three major crises America has had: the Great Recession, which we all know about, they were starting to forget even that courtesy of COVID, the Great Depression, which hopefully will never be forgotten, but one thing called the Panic of 1837. And I only realized about this myself when I produced this chart, because I saw, hey, there's amazing negative credit here. What's going on? And I looked back and found that was called the Panic of 1837, which was regarded as the greatest crisis of capitalism at the time. Then we have the 1930s, the longest crisis, and then the brief one we had in 2008, where some of the actions neoclassicals took, they ran the Federal Reserve and the Treasury, helped to some extent and slowed down how long it remained negative. But it would have been a damn sight better if post-Keynesians had been in control. So looking at that, private debt does matter when neoclassicals assume that it doesn't. It's the most volatile component of aggregate demand, and it's the only one that can turn negative and very, very rapidly. So Fisher was right. This is the guy we should have given the Nobel Prize to, posthumously. I don't care, that's not part of the rules. And for the right reasons. He understood endogenous money and he rejected loanable funds. So dear old Ben, who's praying there, should have remained in church and not had any impact on policy. Fisher's the one we should have followed. Now, this is Fisher from 1932, saying new money is created not by the Mint or the Bureau of Engraving, but merely by the pen and ink of the banker and his customer. And then he says, when the customer then repays the debt, he undoes the whole transaction. The payment of a business debt to a commercial bank has consequences very different to debt paid from one individual to another. That a man-to-man debt may be paid without affecting the volume of outstanding currency. Whatever currency is paid by one is received by the other and is still outstanding. But when a debt to a commercial bank is paid, that amount of deposit currency simply disappears. So Fisher knew what he was talking about. Bernanke did not. And as usual, the idiot overrules the wise person in economics. And you take a look again at that 1940 20 to 1940 data. It's just taking the same data I showed you a moment ago, but accentuating it. Look at the period there of negative credit. Okay. And the intriguing isn't just the original downturn. It's also what happened in 36 when Roosevelt was persuaded to go back and to try to balance the budget. And what happened was people went back into deleveraging. So we had a restoration of the downturn, and unemployment went from 11% back to 20%. Unemployment's measured over here. And that, I think, is why Keynes was received so well, because that happened at the same time the general theory came out. And at this point, neoclassicals were in complete despair. And that's where they should have stayed. Unfortunately, the buggers revived themselves afterwards. But they couldn't understand it. Please give us an explanation. Keynes comes along, and wonderfully, even better than that, Hicks comes along and reinterprets Keynes as a neoclassical, and everybody's happy. And we had the post-World War II neoclassical revival. But again, this is the data. I just find this gobsmacking that I've shown this charts, dozens of conferences. I've never seen one neoclassical follow up on it. According to them, the correlation of these two series should be roughly 0. It's roughly 0.9. Okay. When credit goes up, unemployment goes down. When credit goes down, unemployment goes up.